Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 8, 2021. Please see our disclaimer for important information. Here's our COVID tracker for the week, pulled from actually a Federal Reserve Board publication. And I put this one in here this week because it also includes hospitalizations, which is the line in the green sandwiched between the 7-day moving average of new daily cases as well as new daily deaths, which continue to trend down. Obviously, a lot of the economic restrictions that have been placed in our communities have been a direct result of bed utilization and resource utilization within hospitals. And the good news here is that we can see that rate of hospitalization has gone down at least more than half, and that with a slight recent uptick, small uptick in daily cases and daily deaths, the trend line is clearly down as we get more people inoculated, we get a broader vaccine rollout, so on and so forth. We've got some vaccine slides coming up in the chart pack, which I think will be very illustrative. Here's our daily vaccine dose administered chart. We've shown you several weeks in a row. When we had the bad weather here in the States, and particularly here in Texas, obviously there was a lot of vaccination centers that were shut down, deliveries were not made, and basically a lot of activity was just shuttered for a better part of a week. And you can kind of see that and how this line kind of flattens out a little bit in the week before and after the storm, but it's generally upward sloping. Good news is here that we've seen in just the last week another leg up in this, and particularly here in our local area around the Cedar Park, Austin area, we see a lot of activity, lots of new areas opening up for vaccinations, etc. Now, if we look at this chart, this is the Pfizer, BioNTech, and Moderna doses administered. Eventually, it will begin to filter in the Johnson & Johnson virus, which just received its emergency use authorization here within the last week or so. It is now beginning to ship, and we'll begin to have those numbers filter in. And we actually, coming up here, have a slide that kind of budgets in the estimated vaccination flow from J&J. But, as we sit here, as of March 3rd, we've got a total of 80 million doses administered. Now, again, these are two-shot regimen for each of these companies here. And so this basically means we've got about 40 million people that have are in the process of being vaccinated, with more and more each day. We see this number beginning to accelerate just a little bit, which is good. So if you consider that we've got maybe, I'm going to round down perhaps to 300 million, that we've got about 13% of the population vaccinated. And as we've told you and showed you in Charts of the Week presentations in the past, the CDC assumes that for every person that's had COVID, that there are probably 4 that did and just didn't know it, were asymptomatic, and so on and so forth. So we're tracking this on a weekly basis so that we can monitor how we're progressing towards that herd immunity that's very important for our economy. This is a chart from Evercore ISI, which does, as I mentioned a few seconds ago here, budgets in the vaccination flow from J&J. And in that middle, the line represents the total number of people. And this slide, which is reprinted by Fidelity in their weekly chart pack, basically indicates that we should be able to inoculate the entire population by June. And there are obviously going to be some of those folks that are not going to want to be vaccinated. Some people that are probably interested in being vaccinated, but are still alarmed at the speed at which these vaccines have been developed, and they've got a little bit of a concern. But so far, the side effects, particularly on that second shot for the Pfizer, Moderna, that have proved fairly mild, basically a day of chills and aches and whatnot for some people. And tends to be that the younger age cohorts tend to feel it a little bit more than the older ones, ironically. But in any case, we've got J&J filtering in here in the pink in these bars. So if you look at March, we should have basically about 130 million people inoculated. And then, of course, that moves higher and higher more we go. And really do feel like with the advent of the J&J therapy that we've got a real good opportunity that within the next couple of months here that we're going to have more vaccines and arms to put them in, which is good. But this all falls on the heels of the governor's order here over the last week, which opened up the state, at least as of March 10th, rescinded the mask order and allowed businesses to open up to 100%. It's elicited emotions, fairly strong emotions on both sides of the coin. But clearly they're basing this type of decision on this type of data that we're looking at here, that you can get more and more people inoculated. You accelerate the pace at which you're going to have herd immunity, which just by this yardstick alone, could very well be here in the next couple of months. Let's talk a little bit about the economy, and eventually we'll talk about the market a bit before we conclude today. This is a chart of for JP Morgan, Citigroup, and Wells. Again, this does not have Bank of America in it, which is the largest bank in the country. But for these three banks, it plots on a black line the loan loss reserves as a percent of total loans, as well as in the amber line, an aggregate loan loss provision for those three banks. And if you go back to 2008, and this is why I put this in the chart pack this week, is just to kind of show you both on an aggregate level and on a relative basis the impact of COVID against the prior recession, which was driven by a global financial crisis and a literal crisis of confidence in the banking system as a whole. But on a relative basis, the loan loss provisions as a percent of total loans is much lower than it was back in 2008. However, the aggregate value of the loan loss provisions for these banks is much, much higher, and just I think speaks to the growth of the overall loan books for these three entities. But I think it's important to say that this last recession, what happened with COVID, what's going on with COVID right now, frankly, is just not the same as 2008. And this recession, in many respects, is very different from that environment. But this is just one measure that kind of illustrates, one of those differences there. Something else I found was really interesting in comparison to 2008 was the amount of business bankruptcy filings. And I can tell you that this is something that I didn't anticipate. This is something that a lot of people didn't anticipate, especially with that prior slide and the conversation we just had about loan loss provisions. Now, banks were concerned, not as concerned as they were in 2008 as far as the provisions as a percent of their total loan book, but they were pretty concerned. And this chart kind of tells you that there's implications for the financial sector, which I actually think are positive, notwithstanding the fact that bankruptcies really didn't spike in COVID, despite the fact that we had a lot of small businesses under duress. But we didn't see the bankruptcy spike, the credit problems that we thought we would have. In fact, bankruptcy filings continue to trend down, which is really, really unique. So again, getting back to the implications for the financial services sector, for these lending institutions that have made these provisions against this anticipated credit problem, well, the lack of a credit problem is going to allow these institutions to begin to release some of these reserves back into earnings, in fact. And so as we look into 2021, this could actually be very positive for the financial services sector and banks in particular, especially at a time where we're opening up. We have a global kind of synchronized recovery, if you will, and we have a steepening yield curve. So again, another touch point here, kind of talking about the differences between what we've been dealing with now and what we dealt with back in 2008. Here's a quick chart on output growth and GDP. And in that green line, what that green line represents is basically a trend line growth estimate from the Federal Reserve Board. And in this particular case, it's the economists at the Federal Reserve Board of San Francisco that really does dovetail what the Federal Reserve Board as a whole expects over the coming years. And you can see that the trend line growth dating back to 2010 average, mostly, -1% to 4% over that time, with some variations from one quarter to the next. But as we go forward, we're likely to see some really strong growth actually in the first quarter as we kind of battle back from this trough engendered by the pandemic. But after that, I think we would naturally expect to see some leveling off of growth. And at this point, I think the conventional wisdom is calling for something on the order of kind of 2%-ish going forward, and getting back to that point kind of within the next couple of years. And so, the implications of this in terms of financial planning and things like that are that, I don't think that we should budget a lot of outsized growth. I mean, it's still nevertheless positive, which is very good. We're going to have an expanding economy, which provides the feedstock for earnings growth and for stock equity performance and things like that. But I think we should probably, as we look out over a 5-year horizon, kind of temper our expectations a little bit for longer term growth because of some of these more systemic things that we're going to have to deal with. Certainly increased national debt, interest rate burden. If interest rates move higher, then that's going to provide a little bit more stress on the federal budget. And there's some things like that we're going to have to reconcile in. But I think roughly 2% on GDP is probably a good working number at this point. Now let's talk about some current indicators. This is the Institute for Supply Management, or ISM, Services PMI Purchasing Managers Index. So this is a price index. As we've been talking about for many weeks now, we've seen this indicator shoot much higher. There's a lot of price increases within the channel that hasn't really hit the end consumer yet, but is building certainly, and building to such an extent that it's going to be difficult for producers, and in this case, service industries, to take lower margins to avoid the impact of having to pass those costs along to consumers. And at some point, there's going to be a breaking point. And they're going to be, you're going to see those prices within the consumer channel begin to increase. And I think this is just another continuing indicator of what some of those things are. As we look into other areas of stages of production, we've got iron ore on the left. We have domestic steel on the right, and these are, basically on the steel side, it's hot rolled steel that you can see these prices, coming out of 2020 are exceptionally high and much higher than they've been over a longer trend line. And the data series on the right goes back to before 2010, and we haven't seen these prices in steel. Again, you think about cars, you think about washing machines, you think about other durable goods that require steel, and this is the input cost that we're talking about. Certainly on the automotive side, it's going to have an impact in the months to come, and just the degree to which these things have moved higher is raising a few alarm bells here right now. On the left-hand side, we've got basically lumber prices. There's lots of different proxies for lumber. This is just one. This is a strand board composite price index, and so this is, you can think about housing. You can think about other areas of the construction industry, and this is a primary input cost, as you might imagine. So just like we saw with steel in the prior slide, we've seen prices that we haven't seen in a long time here, and as a result, we're importing more lumber, which is a chart on the right. So obviously there's a demand for stick building, for home building. There's a demand for a lot of construction right now, and The challenging aspect of this is that cost inputs are moving higher. We've got a chart here on federal spending, and it's always good to kind of monitor this because we did see, at least from 2000 to 2010, kind of an attenuation of this prior to post 9/11 actually, and kind of into the throes of the Obama administration here. But it's since really 2011. 2012, we've had non-discretionary spending as a percent of total federal spending really spike. And so what are the implications of this? So, I mean, just by its nature, this is non-discretionary. This is entitlements. This is Medicare. This is a lot of things that we just can't control. And so when you think about that line moving higher here lately, and probably close to 70%, that only leaves us 30% of the federal budget that has some flexibility to it. And so, as you can see in this upward sloping trend here, that we're becoming less and less able to move the discretionary needle because of the entitlement programs that we have. Now here's a chart that I pulled from RSM, data from the Bureau of Economic Analysis as well as Bloomberg on real personal income. And the motivating thing about this chart is that it excludes government transfers. And we've had other charts in the pack, and we've been talking about the rise in personal income by virtue of the stimulus payments. And so obviously we had round one in the post, anxiety moment there when we realized that we were in a pandemic, and then we have the second one towards the end of last year. Those obviously bolstered incomes, bolstered savings rates. We've been talking about that. We've been showing you charts that kind of show that spike in income, but this one is interesting in that it removes the government transfer aspect of it. And I think what's really telling here in that red circle there is that if you take away all of the government transfer payments, that real personal income growth year over year is actually negative, and is trending, actually trending back down. And if you smooth the effects of the pandemic, which is that large drop there within that circle, you can still see that the trend is down over multiple years, and this is something that is going to eventually speak to consumption and the health of the consumer, which accounts for 70% of our economy. And again, I'm not raising any alarm bells right now, but it is very interesting to note that if you take away all the government stimulus, that real personal income is negative. Well, no chart pack during March of 2021 would be complete if we didn't talk about inflation, because inflation is certainly on the rise. The surprise index from Citigroup here shows you that those inflation expectations are building. We just showed you a chart with prices within the production and within the services channel, and steel and lumber, and all of these things are conspiring to push this particular index higher, which builds the feeling, builds that notion of future inflation, which has been moving this 10-year Treasury yield higher. Let's talk about the stock market here. We are at an interesting juncture on this trend line. So this is the 50-day moving average, which is this red line here, if you will. And it shows you that we've tested that 50-day boundary on a few occasions, very poignantly here in September, and then basically at the end of September, and then basically at the end of October, beginning of November. And we were dealing with a spike in coronavirus cases and things like that back then. Now we're on the advent of mass vaccinations and this path towards a visible path towards herd immunity. But interestingly enough, we're almost at a point now where good news is bad news for the market, because it's beginning to insinuate that that growth is good, but it could be better than we can handle right now, and it might lead to outsized inflation. And last week we had Jerome Powell, Fed chair, really kind of talking about their lack of concern over the inflation glide path. And so I think there's some fear out there that we might overheat, and the Fed is going to kind of stand off to the side for the time being and kind of let the market run a little bit hot. And that's taken a little bit of steam off of equities here lately. And we're at an interesting technical standpoint in testing that 50-day moving average, as we did actually back in February, but then bounced back off of it. So it'll be very interesting to watch how the market reacts from this point going forward. I thought I'd put this in here to kind of give some feeling and some context to this long-term trend line. And this is kind of a financial planning slide that just shows you the strong upward bias for long-term returns. And this time series takes us all the way back to 1900. And then we've had, secular bulls, and then we've had, periods of extended periods of consolidation. And then in this chart from Fidelity, shows you, two very long periods of time where we had a fair amount of consolidation and sideward movement in the economy. And I go back to 1969 to 1982, which is 1982 is when we had continental Illinois, and that's when we had ultra high interest rates. And Fed chairman at that time, Paul Volcker, decided to institute a war on inflation. And that's when we saw a spike in rates, and then eventually we saw those rates begin to come down over a long period of time. And you could see in that green shaded area that pronounced secular bull market that went all the way to essentially the end of the century. But since then, what's interesting, we've seen some another transition period and a period of growth, which was punctuated in the middle by the 2008 global financial crisis. But even though it took us a while to kind of build ourselves back out of that trough, we didn't really have the flattening out, if you will. If you look over a long period of time, over essentially 13, 14 years, and then what we've been led to, or what this has led to, is another kind of breakout, if you will. And the question is, what is the next 5 years going to look like if we have higher inflation and we have maybe below trend line growth, perhaps because we've got so much federal debt, and we'll eventually have, as interest rates move higher on Treasury debt, the interest burden on our federal government will increase, and so we'll have some other things to contend with. And I think the thing to watch here is what the next 5 years holds with the backdrop of these long secular bull markets. Couple of indicators here that I continue to watch kind of as a form of health check on the corporate sector, and these are corporate buybacks on a 4-week moving average. And coming out of the pandemic, we saw a lot of companies that basically stopped their stock repurchase programs, and we saw a lot of companies that curtailed or actually ceased paying a dividend for a while. And a lot of those firms that did that last year beginning to come back out and reinstitute those programs or increase their rate of activity, so on and so forth. And so what we're seeing in 2021 thus far is a fairly strong rebound in stock repurchase activity, which is getting capital back into the hands of shareholders, which is a very healthy sign for the economy and actually for the market as a whole. And here's a chart on company cash, and this is, again, not the small business sector, which we know, the Main Street and Wall Street are really two different things, but this is just as it relates to the health of the S&P, the health of the market, that we've got companies that are sitting on a tremendous amount of cash. which is a tremendous amount of liquidity. Obviously, they're going to be looking for opportunities to deploy that cash in an amicable manner. Just mentioned a second ago that dividends are probably going to go up because of this ability to pay higher dividends. I think we'll see more consolidation as companies are looking to acquire growth, where in areas where perhaps there might be, otherwise limited opportunities to get it organically from business expansion, but a very healthy sign right here for the market. Now, talking about valuation, this is the MSCI All Country World Index, and there's several things going on this chart. There's actually the index itself, which is in the solid black line, but as you look down below in the gray line, this is the net percentage of equity markets that are in an uptrend. And so, I think it's clear from this that the U.S. This market increase is not a U.S. phenomenon. I mean, we've seen a global response. I mean, we've actually seen fairly strong, if you take out the last couple of weeks or so, fairly strong performance out of the emerging market sector. And despite the fact that we've had a little bit of dollar strengthening this year. So it's been very interesting to watch here as you see that gray line spike on the right-hand side, that we have a very high percent of equity markets across the globe that are in an uptrend, which I think in many respects is very symptomatic of the synchronized global economic recovery that we're in the middle of. But it's not always that you see equity markets and economies moving in lockstep. Usually there's some kind of a lag or some kind of well, I'll just call it a lag period between, when the economy improves and when you see it manifest in the economy. And sometimes you see the market begin to anticipate economic growth before it occurs. But very healthy to see the global marketplace in an uptrend. Let's pivot a little bit to fixed income, and this is something that that I've talked about in the past. We've seen kind of bar charts. This is kind of one of those cumulative trend graphs that shows you the growth in, I would call it, very lower tier investment grade debt. And when we were sitting here at this point last year, beginning to wonder how the pandemic was going to evolve, or at that point it was just literally being defined as a pandemic. One of the things that we were worried about is we had a lot of this debt that is marginally investment grade. And if you look in the green shaded area, you see the tremendous increase in the amount of BBB rated paper, and really we've also seen an increase in A-rated paper, but we haven't seen the growth in the higher tiers. And so what this means is that if you have an economic bubble that bursts, like we did last year, literally this month last year, that we were going to see a wave of defaults. And I know we just talked about this a few minutes ago, that we didn't see that, but the real risk was that we had all of these marginally investment grade credits, and there was going to be a ripple effect in downgrades. And then there's a lot of indexed fixed income funds that have to own certain of these credit tiers. And so there's high yield funds that can only own less than investment grade credit. And then there's investment grade bond funds that can only hold investment grade credits. And so if you're BBB and you're essentially 1 to 2 notches away from not being investment grade, there is a little bit of anxiety that comes with economic downturns, and what the impact is going to be on those companies and the credit rating agencies. Are they going to downgrade these credits? But you see that BBB makes up the majority of our bond market right now, and I guess it's in hindsight, it's been encouraging to see that we have not had the credit event that we thought we were going to have, but always something that we want to pay attention to going forward. Well, without question, the big story here in the market over the last several weeks has been this dramatic rise in the 10-year Treasury and the implications it has for mortgage rates, which just noted that the 30-year fixed mortgage rates just popped above 3% for the first time in a while. And this is beginning to drive some speculation over the kind of the near-term future of the investment markets, because as we were sitting here at the beginning of the year, I think our best guess, when interest rates were barely around 1%, that we might see 1.5% by the end of the year. Well, it's gone past 1.6 at times here already just in the last week, and so the concern is that we might see more inflation build in the pipeline. And so inflation expectations, as we've already shown this week, have really spiked, and what that's doing to interest rates is moving it higher. So obviously it's good for savers, not so good for borrowers, and certainly not so good for longer term, longer maturity and longer duration bond portfolios that are being price impacted by this rather dramatic move. And if you look over a longer time frame, we're not out of bounds in this type of move. In fact, I'd say that a lot of it has to do with normalization to an interest rate level that would make better sense. And you would think that 10-year treasuries would move higher with inflation, as we see the target inflation being 2%, and we're not there yet on the 10-year treasury. And we've seen a change in leadership on basically the treasury yields moving above the earnings yield, the dividend yield on stocks. And we haven't seen that for a little while. So I think this is very much symptomatic of an improving economy. And the real question is, can we avoid the outsized and certainly the unexpected bursts of inflation that the market has never liked? In the wake of rising interest rates, I thought it was interesting to show this chart, which is net foreign purchases from data that comes to us by way of the Department of the Treasury. And it almost kind of acts as like a proxy for what foreign entities, both sovereign and otherwise, basically, if you treat them as portfolio managers, it kind of gives you a sense of what they're thinking. And the interesting thing here is that we've seen a rather dramatic decrease in the amount of total purchases that are tied to government bonds, and we've seen a dramatic increase, really over a few years now, of the dramatic rise in purchases of U.S. equity. So this didn't change just because interest rates went up a few weeks ago. This has been a little bit of a trend that's been developing, and I thought this was really interesting. I wasn't expecting to see this line begin to develop last year, but it certainly has. And so what's really interesting is that domestic investors continue this mass exodus out of out of domestic equities and into domestic bonds, but foreign purchases of U.S. equities are actually going up at a much faster rate. So interesting to see how the market is in some respects underpinned by the volume of these foreign purchases. Okay, in this chart, we kind of continue this discussion of the 10-year Treasury. This is information from Goldman Sachs that's put together by their team, and what it does is it gives me a little perspective on maybe some of the volatility that we should probably be looking for, or at least looking for continuing within the equity market. So over the last month, we've seen over a 0.5 percentage point increase in the 10-year Treasury, which on the top chart represents, in very mathematical terms, a very large move, 2.6 standard deviations to be exact. And so on the bottom part of this chart, what they do is they say, for all of these for all of these moves, what has been the impact on the equity market. And so when you get beyond the move that we've had, again, 2.6 standard deviations, when you get above a 2 standard deviation move in a rolling 1 month change, that tends to disrupt equity markets, at least for a short period of time. And so we're clearly in that territory now. And so what this tells me is and I've said this for several weeks now, that I think the prospect, which is confirmed by this chart, and this goes back and looks at data, the prospect of having a 5% correction, if you will, I'd say is very reasonable at this point. Again, this is not a crisis situation in the least bit. In fact, interest rates are moving higher, I think, for all the right reasons, that we have growth, and it's leading to a little bit higher inflation as our productive base catches up to demand coming out of this pandemic. But as I've kind of tried to reinforce before, that oftentimes is not the way it translates to the equity market is not completely linear, which means that you have little hiccups along the way. And I think we're at one now where the market's trying to reconcile these interest rate moves and trying to make sure in its own mind that we're not going to overheat, which I think is a risk of the market, but especially coming after Fed Chairman Powell's comments last week. But I think just be prepared for a little bit of volatility. We'll get through it. I think the longer term profile is extremely good, and I don't really see any large pitfalls. Here we have a chart on gold to kind of get you caught up on the goings on in the gold market. We have seen a rather strong response in gold prices coming out of last summer, and when they reached their interim peak, we've seen the dollar begin to strengthen a little bit, just modestly over the last couple of months. We've seen interest rates move higher, which when you think about interest rates being higher, it's a competitive asset for gold, and so we've seen a little bit of disintermediation out of gold for those reasons, and obviously we've seen a little bit of a change in real yields net of inflation, even as we've seen inflation expectations begin to build in the pipeline. So it's taken the luster off gold, and I do think gold will probably struggle a little bit near term, and it doesn't pay a yield as a lot of other assets do. So there's no yield to offset the price move on an interim basis. But as we begin to settle into this, this new era of higher inflation than we've been used to, I think there is a place for gold. Right now, we're just in a little bit of a kind of a catharsis, if you will, as we change from this kind of interim pandemic to a post-pandemic environment where there's kind of a new set of circumstances that we'll be addressing versus what we had to contend with in 2019. But I do think that there is a place for gold in portfolios as a hedge to the volatility in the equity markets. In our last chart of this week, I just wanted to focus on energy coming out of the snowmageddon here in Texas from several weeks back. I think it's interesting to watch. Again, not making an environmental statement here, just pointing out just the changing the guard, if you will. On the left-hand side, this is from the Energy Information Administration, the EIA, government agency, and it goes back to 1950 on the left-hand side, when obviously our kilowatt hour usage began to rise, baby boomers, expanding population, so on and so forth, and a lot of that was met by coal. And after 2000, no doubt read that there's been kind of almost like this attack on coal, and we've replaced a lot of the coal-fired generation with natural gas. And so that blue area continues to expand, even at a time where, perhaps on a total level, our kilowatt generation has kind of flatlined a little bit. But you can see in the green area, we've got an increase contribution from renewables, which, here in Texas, obviously we were talking about, what did the kind of the freezing up of the wind turbines do to the power grid. And I think the wind turbines, at least here in Texas, as it relates to ERCOT, our basically our grid operator, that on baseline load in winter, it accounts for about 10% of our load, and has the capacity to add, to contribute up to 25%, depending on the circumstances. But you see overall, wind and other renewables are really beginning to rise. But at the same time, we still have a lot of power that comes from nuclear sources. And again, coal hasn't gone away, but it's decreased in its relevance, whereas natural gas continues to increase. And here in Texas, we also had an issue on gas transport lines being frozen up. And a lot of the transport mechanisms on natural gas depended on water that wasn't available. And so, you look at the green area, and certainly the blue area, just as it relates solely to Texas, and you can see the impact there. But on the right-hand side is just kind of more of an X-ray from the EIA on renewable energy sources. And for so long, I guess that component has been satisfied by the hydro, basically water coming through dams and coming through other channels there. But you can see that the wind is certainly picked up here after 2000, and that green line on the left is being supported by the expansion of wind in some of these other areas. And so as we think about our grid moving forward, when we think about ensuring that we have enough power to support our growth, it's clear that all of these areas are going to have to be supported to some degree. All these areas are going to require some investment. And even though, there are a lot of folks that want to control the amount of, dirty energy generation, like from coal and whatnot, that obviously a lot of money is going to have to be spent on infrastructure in a lot of areas to ensure that we've got the power to meet the growth in our population and the growth of our industry as well. Well, that will do it for this week. Hope you've enjoyed the presentation. On behalf of everybody at BKA Wealth, all my colleagues and teammates, thank you for listening to this presentation. Please feel free to reach out if you have any questions or comments. We'd love to hear from you. In the meantime, have a safe week, a productive week, and we'll talk to you again very soon.